Vantage Point with True North Wealth Partners is for our clients and those wanting to learn more about what's really going on within the markets and economy, as well as overall financial planning topics.
Hi folks, welcome to Vantage Point, True North Wealth Partners. Eric Soucy here. It is Wednesday, July 24th, episode number 44, which is our second quarter updates. So hope you are having a great summer. It's gone fast. I cannot believe the first quarter has come and gone, second quarter's come and gone, and now we're into the third quarter. But I just want to give you an update because a lot has occurred over the past quarter or 3 months here. For disclosure purposes, also don't forget to hit that little red subscribe button. So anytime we produce these, you'll get them automatically sent to your notification. So for compliance, I just want to read this so you're aware. So anything I hold up or what have you, basically information has been obtained by a third party, which are believed to be accurate, but we cannot guarantee its accuracy or completeness. So I just want to be sure when we hold up information, that's a disclaimer for that. And then if we talk about asset classes or products or anything like that, diversification, again, the following information is general information only and is not intended to be specific investment advice. It's important to consult a financial advisor who understands your individual financial situations prior to making any investment decisions. And again, our clients, we are fiduciaries. So this just happens to be for folks who are not our clients who happen to stumble onto this. So that's great. And I appreciate you hanging on and listening to that. So with that said, let's just get into a recap of basically first half of the year. So bifurcation, if you may have heard of that, or the K-shape economy. Okay, so again, half's good, the other half's not so good as far as people in general, United States, markets, etc. So the bifurcation with that, the S&P 500 again is made up of 500 stocks. You've heard of the Magnificent Seven, obviously. Okay, Tesla was included in all that. So with that said, this is actually produced by Y Charts. So it's one of our resources. So I am going to hold this up, and Nathan, our producer, will scan and focus in on that so you can go along as I read to you. So again, the Magnificent Seven, that's in the light green line. That has done basically 31%. Year to date. This is going through beginning of the year through second quarter, June 28th. So just to reference that point, those 7 stocks, basically 31. The S&P 500 level exchange, basically, it's done 14.48. And then the S&P 493 stocks. So you carve out the 493 stocks, is only up 7.35%. So again, that's the low end for 7.35 for 493 stocks. Now we'll go to the dark green, the very top is the trio of only Microsoft, NVIDIA, and Alphabet. So again, those 3 stocks are basically 50%, 49.28%. You can see the high was earlier on in June there at 52.83. So what I'm trying to say, and upshot, this is the visual for it, is you have, call it, 3, 5, 7 stocks at most are driving the vast majority of the returns. That was the first half of the year. So that's the bifurcation. The good news is you're starting to see things broaden out, okay? When I say that, and what I mean by that is small caps have been underweighted and have not done well for the past 2 years. Finally, they're starting to sprout a little bit. So you've seen that over the past 2 weeks. So that's good. So things are starting to broaden out a tad. So I just wanted to touch base on what you're seeing on the headline, or I call it old wall. Okay, so that's just regular benchmarks, what are not indicative of your well-diversified portfolio, which is made up of a lot more than just stocks or large cap, small cap, and things of that nature. So that I wanted to touch base. Next, second quarter GDP. Again, this came out today from GDP Nowcast from the Federal Reserve Bank of Atlanta. And again, it's going to read to you the updated second quarter GDP is now came down a little bit, 2.6%. So again, from the Federal Reserve Bank of Atlanta, roughly 2.6. Other folks are predicting even lower, like Hedgeye and other firms, roughly like 2.1 are out there on the street. So we'll see when they always finalize the revisions down or up, but we think the GDP will be settling a little bit south of 2.6. And then the first look at the GDP Nowcast, again from the Federal Reserve Bank of Atlanta, is going to be for the third quarter, which is what we're in, is on the Friday, July 26th. So we'll see. That will be probably my first guesstimate will be low twos or high single digit. So the overall economy is slowing. So I anticipate the GDP nowcast for the third quarter to be, low twos at best, I guess. So that is in regards to sort of what's happening on the economy. So a couple little things. In addition, obviously, we use Hedgeye. So with Hedgeye, it's one of our preferred vendors for Research Center information. And again, Nathan, my producer, will hold up. What do you mean the winds have changed? Just a quick little chart there. So he'll zoom in on that for you. But yes, things change rapidly these days. 0-day expirations, options expiring. More than 50% of the trades occur 0-day expiration same day. So again, the buy and hold for years on end is not really all that coming into fruition anymore. So with them, we're entering, and again, this is the monthly quads. This is produced by Hedgeye. Just came out. This is on Monday of this week. So this is their latest. There's over like 40 or so data inputs. Around 40 or so data inputs gets inputted into their models. These are monthly quads. Just remember, folks, quads 1, 2, 3, 4. Quads 1 is spring, 2 is summer, 3 is fall, 4 is winter. So if you, again, Nathan's holding that up. If you focus in a couple months ago, focus in on September of 24, a couple months back, you have to take my word for it, but that was a quad 2. Okay, the conditional probability was for a quad 2. Well, a few months later, it's a quad 4, okay? It's a narrow quad 4 for September of this year. But as you can see, the pinkish is the vast majority rather than a quad 3, rather than a quad 2 or a quad 1. So that's how you can determine the greater the color, then that's the conditional probability. And these were developed with accuracy of basically 75% accuracy. So again, we use Hedgeye to try to front run what's coming 30, 60 days out, get ahead of things. So we anticipate things getting a little more choppy, buckle up. No recession, just obviously more pullbacks, easily 8 to 12%. And the S&P 500 is what I am foreseeing occurring between now and the end of the year. But again, both directions, both up and down. So hence why more rebalancing will be going on. Again, Andy, I spoke to the guys earlier this morning. So they're going to be still tweaking their portfolios. Eric Biddle as well, Russ. So you'll see small tweaks. There'll be more major rebalancing going on for my clients. So I just wanted to give you, a heads up with that. We'll be introducing nuclear. I'll talk more about that, and uranium. That's going to be around for a long time as far as powering up all the data servers, which I'll get to in a moment later on. So with that, again, Q2 inflation coming from, again, Hedgeye. They expect that like 3.2. Q3 inflation ticking down to 2.96. And then Q4 inflation, CPI reinflating, going back up to 3.35. So the markets, and again, CPI inflation in general, the markets, the Fed, think they're going to be heading down to that PCE number of 2%. That's more than likely not going to happen, and it's not priced in the stock market. So that's hence why volatility will be picking up. And then Q1 2025 inflation reinflating to 3.61. So again, Q2 is 3.2, Q3 2.96, slightly going down. Q4 going back up, reinflating to 3.35. And then Q1 of 2025, reinflating even higher to 3.61. None of that's priced into the equity markets. So with that said, and again, I shared with you the quad, the months. It's all basically 2s and 3s as far as the chop going back and forth. Quad 3, again, economic growth slowing while inflation still sticky and higher. So that's why we're going to be bouncing between month to month between quads 2 and 3 for them pretty much. So I want to just talk briefly about for my clients. I know Eric has used Biddle, has used buffers in the past. Andy as well has used buffers in the past, and I am using buffers for my upcoming rebalance. So I wanted you to be aware of that. And basically, folks, what a buffer, just as a quick recap, it provides some downside protection. So basically, it gives you about 15% downside protection with still upside growth. So if we're totally wrong and the S&P 500 goes up, 14% or 15%, great, you're good. The upside, there is a cap. It's roughly around 14%. So there is a cap. It's roughly around 14%. But I personally don't think the S&P is going to be going higher over 14% over the next 6 to 8, 12 months. Not right away, at least. So hence why we have this new buffer coming on board to protect the downside. So if the markets are down, 12, 13, 14%, 15, typically your portfolio will be made whole, meaning you don't lose anything there. So that's how buffer ETF works. If the S&P were to be down 20%, then yes, you would be down the difference from 15 to 20 is down 5. You'll be down 5 instead of being down 20. Okay, you're down 5. So that puts a nice little airbag on that. So that's why nothing wrong with that. We build out models to use alternative investments. You already own a lot of that. This is pretty cool too. This is from First Trust. So again, allocation to alternative investments, basically 6% of advisors, professional financial advisors, use alternatives. Well, I've been using them for years, so obviously I'm part of that 6%. But typically it's endowments, family offices, pensions, high net worth, up to 20%. So, my clients definitely have a lot of alternative investments. And the reason why it provides efficiency by adding alts is to lower the standard deviation. That's the orangest line. So it lowers the standard deviation, but still providing you higher overall return. So lower volatility, lower standard deviation, higher return. Hence, that's what the alts portfolio brings to the table. This is looking back over a 15-year period. So those two charts came from First Trust, and I just want to talk to you about the buffer ETF. So again, other guys have used them in the past. I'm going to be using them because I'm thinking things are going to get a little more volatile, and they're going to be tweaking their portfolios as well. So I just want to give folks a heads up on all that. So with that being said, just a couple of things that are interesting. This is from Global Payment Reports. Okay, Veronio by Visual Capitalist. This is the chart here, the extinction of cash. So this could be good or bad, but the upshot, and Nathan will hold this for a little bit, it's just interesting how as a projection of what we were paying in cash in 2019 versus 2023 versus projected 2027. Look at the United States. Again, let's just call this like 15, 16%. United States were cash transactions back in 2019. It's gone down in 2023, okay, like 12%-ish. And then they see it getting closer to that sub 10, 9, 10% projected by 2027. So that's just the United States. So again, look at India, next to the left one there. So India, in its, again, 2019 was well over 70% transactions were cash. Already gone down to, let's call it, 19, 20% cash in 2023. Going to be about, let's call this 11, 12% cash projected 2027. So there are big change as well in Nigeria too. So just interesting. It's good and bad, just because if government or things do things for the wrong reasons, they can turn on and off your accounts, cash, investment vehicles. You've seen that already in Canada. It's been done. China, it's been done. So I'm a little hesitant and not all giddy about all that, but to just want to show you the trajectory of what's coming. And most folks already know that. Also, what's powering the world in 2023. Again, coming. This one's from the Energy Institute. Okay. So again, Visual Capitalist, but this is a chart Nathan will hold up there for you. But it's just interesting to see what powered the world in 2023. Coal was 32%, oil 23%, natty gas 26%, nuclear only 4%, hydro 6%, and other is the wind, solar, and all that's 8 combined. So the point is, with, going green and all that, that's great, all for it. However, nuclear is the way out. So small nuclear reactors, these little modulars, they're going to be placed next to data centers, things of that nature. So hence, you will be seeing that fund in my upcoming rebalance as well. So uranium and nuclear is part of that. So that is, what's coming. With that said, I do want to touch base briefly on Social Security. So Social Security last year, again, cost of living adjustments was 3.2%. Okay. So 3.2% was Social Security increase for 2023 was 3.2%. That was last year's COLA. The estimate, now this is coming from the 2025 Social Security COLA estimate, is currently at 2.63%. This is coming from FA Magazine, dated July 11th. So July 11th, FA Magazine, the estimate first blush is 2.63% instead of 3.2. Again, there will be a revision. The final will come out in October of this year for January 2025. But I thought I'd just give you a heads up on what is projected. They talk about here, basically, grocery items tracked by CPI has risen 24%. Eggs leading the way, 86% increase since 2020. It's incredible. Many other items, including bread, coffee, sugar, orange juice, cocoa, gone up by more than a third as well. So, just wanted to keep you abreast of what's to come. In addition, I'm sourcing this from my ARP bulletin dated July, from the ARP bulletin in July. I just want to read to you mixed news for Social Security and Medicare. So Social Security benefits, good news is, they come up with, the government runs their projections of, hey, when's the Social Security going to run out of money, things of that nature. It won't run short of money until 2035, so it's a year later than what was predicted last year's report. So 2035 for Social Security, and then you'll have to cut it by roughly 85% reduction there. Meaning you get 85% of your benefit in 2035. Medicare Trust Funds Part A, which helps pay for inpatient hospital visits, will cover all its bills until 2036. That's 5 years longer than forecast last year. So 2036. So that's Part A. Okay. And then Part B and Part D. Part B is doctors and service outpatient care. Part D is prescription drugs. They will have enough money indefinitely because premiums and the federal contributions are automatically adjusted each year to cover the costs. So Part B, as a first blush, what they're thinking about Part B premiums is going to increase to $185 per month starting in January 2025, up from $174.70. So basically, let's just call it $10 more a month. First blush. Again, their premiums are also going to be set in the fall. So I just wanted to run through that for you. Part B premiums, first blush, could go to $185 instead of $174.70, so almost $10 more a month for Part B. So that's all that. Okay, folks, let's get into our tips of the month. So I always like to have fun with tips of the month. Strap in, a lot of good parts here. This is coming from Beyond the News, and it's by MFS. This first one is dated July 17th, and the other one I have is dated July 22nd. But I just want to point out a few things. But with that, just a side note, the Ohio sales tax. Remember, folks, we're having our Ohio sales tax holiday coming up August 2nd through the 4th. That's my public announcement for you all. So please shop on August 2nd through the 4th for certain items will be tax-free for the sales tax of Ohio. All right, so going back to some other things, bankruptcies. So bankruptcies the first half of 2024, 346 companies filed for bankruptcy. It's the highest first half total since 2010. Okay, 75 companies filed for bankruptcies in June alone. So again, 346 so far in the first half. So bankruptcies are going up, delinquencies for auto, credit card, things are, still elevated and trending a little higher. Air travel, good news. So people are still spending money. Okay. So 2/3 of the economy, GDP is consumer spending. That's great. So we hit over 3 million travelers on July 7th of this month. July 7th, TSA reported a record over 3.013 million travelers. That's great. VA data centers. Okay. This is incredible. So data centers, electricity demand in the U.S. finally ticked back above the pre-COVID levels, rising 1% From 2019 to 2023, Virginia, home to 35% of the world's hyperscale data centers, seen the biggest increase in demand of any state. Okay, so that's the data centers. Obviously, Virginia has the most, DC, all that's there. But power hungry, again, driven massive data centers. Google, Microsoft, each consumed 24 terawatts per hour of electricity in 2023. So again, Google, Microsoft, 24 terawatts per hour of electricity was consumed by them alone, which is more than the total annual energy consumption of 100 other countries, including Jordan, Iceland, Ghana, probably pronounced that wrong, sorry, Dominican Republic, etc. It's just, they suck up a ton. Hence, why you need those small nuclear reactors to be placed right next to the data centers, because they're just sucking up all the coal, the energy, you name it. Gas is what's driving most of that, not necessarily the solar or wind, because it's not fully reliable. So that's why you have to have that. Ditching insurance, another thing. So I have a buddy of mine lives in Florida. So Florida homeowners are opting to forego home insurance. So my buddy dropped his homeowners insurance. Florida ranks only 10th in terms of the states with the highest percentage of uninsured homeowners insurance. Topping the list, though, of people getting rid of their insurance for homeowners insurance is Mississippi at 13.3. Florida is basically 9.9. Almost 10% of the folks are not owning homeowners insurance. That's what my buddy did, got rid of it. This is another tip of the month. This is really cool. Where the stocks have gone. Where are they? Okay, so for the end, this is year-end 2022, okay? There were basically 4,642 stocks, individual U.S. companies of stocks, 4,642. 26 years ago, back in 1996, there were 8,090 companies. So the delta, the difference between that, basically the percentage decrease is approximately 43% less publicly traded stocks now than there were, back in 1996. So, tons of mutual funds, ETFs exploding on the things, but fewer stocks. Hence, that leads to the bifurcation, the concentration risk, the Magnificent Seven, things of that nature. Fewer stocks, more folks, fund managers, hedge funds, individual stock people buying the same types of stocks. So when the unwind occurs, and it has happened, it's going to be fast and swift because everybody's in the same ship. So all in the same boat, same side together. Okay, so just a couple tips of the month there. Hopefully you enjoyed that. Let's end on my favorite. I love charts. It's a visual. So remember, folks, you can pause when you're watching this back. You can pause the video podcast and study the chart, blow it up, what have you. So I wanted to make you aware of that. So stock market PE ratios, as you can see, right now it's 21.6 as of July 16th. So again, the average, historical average is 15.7. Tech bubble is 24.5. So you can see how it bounces around over time, okay? Next, evaluations, where we're at. So the PE, price to book, PE, price to earnings, price to book, price to sales, price to cash flow, dividend yield. You can see the range, okay? It's the range since 2003, or the range in the boxes there. Basically, the latest is in the little diamond shape, the bluish dark color of diamond shape. All on the standard deviations are extremely near 2 or a little over 2. So things are stretched. So that's its valuations are stretched. Hence, we're due for a correction / pullback. Okay. VIX, volatility index, ultra low over the past couple months here. Obviously, it spiked up. This is as of yesterday, it's 14.7. Today, I hear the VIX is near 18. And in August, I'm hearing it's supposed to be over 20. So hence why we're doing protective. I have cash on the lines, sidelines as well. So again, the average VIX is 18.3. And right now, ultra low, but it is going to be spiking back up. Pullbacks, remember 5% pullbacks in the S&P. That's very normal. Happens 4.6 times a year. A 5% pullback in the S&P happens 4.6 on average. We've only had one. That was back in April. Soon to be 2, okay? Coming up here over the next few months or month or 2. 10%. That's my prediction, by the way, my opinion. Pullbacks, 10%. Again, that occurs on average 1.2 times a year. And again, we haven't had one yet. We only had one 10% pullback last year. And again, we haven't had one yet, but I anticipate, in my opinion, to see that occur between now and the end of the year. all-time highs. This is great. Hey, folks, last year we didn't have any all-time highs. The year before that, in 2022, we had one all-time high. This year we have 38 all-time highs in the S&P 500. Okay, this is through July 23rd, yesterday. So you can have multiple all-time highs. So keeps feeding the feed, keeps on growing there. GDP Q4 was 3.4. Q1 was 1.4. GDP for Q2 will be, let's call it 2-ish or whatever when the Fed comes out with their final GDP number. And then they're going to start with the third, next week, they'll come out with the third quarter first estimate as well. So the overall GDP is slowing, is what I'm trying to say. Overall growth is slowing. This is pretty cool. This is a 2-in-1 chart here. This is the leading yield curve. This is the 2-10s, the 2-year, 10-year. Okay. So with the 2-year, 10-year on the bond there, it's narrowed. So that, as you can see, is on the right axis. The 210 is negative 0.15. So it was close to 1.5 negative. That's the red line's decreased. So it's shrinking back up. So hopefully it will eventually get right-sided. Okay. So instead of upside down, a negative sloping, a positive sloping yield curve, that will occur because the Fed can control the short end of the yield curve. That's the short end, 30-day, 1 year short end, not the long end. That's the 7, 10, 15, 20, 30 year. They can't control that. The market controls that, but they can control the short end. So as the short end gets cut, then the long end will eventually go higher and the delta, the gap will go positive. But when you do go positive, that too is the beginning of the recession. So this is pretty cool. It shows you the recession and when you're coming out of it, sometimes going in, but also coming out is when the recession. In recessions defined loosely there, you can see, but the point is still market volatility is what's anticipated. Leading economic indicator, LEI, again, over a dozen inputs that go into that. It has gotten better. That's on the left axis. So it was, closer to -7. Now it's only down to -4.8. So you can see how it's crawling back and getting out of the red there. So, this volatility is what to be expected. Unemployment rates, again, the Fed has two mandates, inflation and unemployment. So they want to keep an eye on unemployment. Unemployment will probably, and Hedgeye and others predict it's going to 4.5% unemployment rate. So expect a 4.5% print sometime next year. Right now, it's U3 is what matters most. It's 4.1. So again, they want to see unemployment, gradually increase. Wage growth is going down. You can see all the money that was pumped into the M2 money supply, direct deposit money, all that. But wage growth is going down. So again, when you have inflation still elevated, wage growth going down, people are still suffering. It's harder. Consumer spending, people are still spending money, even though it's come down dramatically. But yeah, people are still spending. Retail sales. This is June. The July was lower than this, so retail sales was 2.3, but it hasn't really. It's just sort of leveling off in that range. CPI, Consumer Price Index, again, what you've been hearing about. The core excludes food and energy. I don't know why they do it, but they do it to smooth out the noise. That's why they do it. But, what matters in life is what's in the people's wallet, and you buy food and energy. So anyways, so that's the core. That's 3.3. It might go down temporarily for the next month or so, but it's going to go reevaluate and go back up closer to the 4% range heading into Q1 of 2025. And the markets have not priced that in. So that's going to be a shock to the system. PCE is just a preferred measure, okay, of what the Fed wants to correlate and target it down to. So the core PCE, they want to get it to 2%. So it's at 2.6. Yeah, it may fluctuate, 2.5, whatever. But again, that's going to turn around and go back up as well. So again, higher for longer. Core inflation across goods and services. So look at the red line, core services. It's still inflating upwards. It's come back down, but you can see it's at 5.6. That's services are still inflation costs. Core CPI, again, 3.3, and core goods. So some goods are going down. Now they're negative, minus 1.8. So parts have coming down, other parts are not. And then savings rate, again, you can see the high savings rate during the pandemic. All the free money that was doled out. Again, people were well over 20%. The peak savings rate was 32, obviously. But with that said, right now, savings rate's about 3.9. But again, the historical average is 6.2. Going back to the 1990s. So again, it's getting tough. People are paycheck to paycheck. So just strap in. A lot of more market volatility will be occurring between now and the end of the year. Oh yeah, the elephant in the room. So yes, what do you have there? So we'll end on the politics side. So it is projected over 75% to 80% projection that Trump will get back into office. Whether it's a full red sweep or not, yet to be determined. Probably keep the House, the Senate should flip, but we'll see. So that's what's being said. On the other side, okay, yes, Biden's gone. They anoint the almighty Kamala. So it is what it is. They call it democracy in action. I have to joke at that one, but anyways, that's just my own opinion as well. So with that said, it is what it is. Let the gloves come off. 3 months of this. I just wish it was November now. Get them back in, get the country back on track, and things will be much better for all folks. Appreciate you folks. Thank you. And we'll see you next time.
You can reach this episode on our website at mytruenorthwp.com, by other podcast venue sites, or by calling us at 614-929-2715. Also, feel free to share this episode with friends and family and sign up for our weekly email market updates via our website. Investment advice offered through Stratus Wealth Advisors, LLC, a registered investment advisor. Stratus Wealth Advisors, LLC, and True North Wealth Partners are separate entities. Opinions expressed in this podcast are for general information only and are not intended to be specific investment advice. It is important to consult a financial advisor who understands your individual financial situation prior to making any investment decisions. Some of the information contained herein has been obtained from third-party sources which are believed to be accurate, but we cannot guarantee its accuracy or completeness. The information should not be regarded as a complete analysis of the subjects discussed.